Investor's Guide. You're watching ET Now. This is a show for retail investors. We'll help you find the perfect investment products in the market. We'll create portfolios for you. We'll pick out funds for you to invest in so you can be rich in the long term. You can write to us. There's an email ID at the bottom of your screen where you can send in any question you have about your money. Let's get straight to it. Over the next half hour, we'll tell you how you can profit from the falling interest rates. We'll also tell you how you can create a corpus of 2 crore rupees in the next 10 to 15 years. And in our product review, we take a look at the L&T Equity Fund. Alright, so let's get started. Now, the good news is we've noticed inflation has been falling over the last month. This basically means that the RBI will probably bring interest rates down even further in its next review. That means on one hand that your home loan will become more affordable and your EMIs will stop cutting such a massive hole in your pocket. On the other hand, it also gives you a very nice opportunity to profit from those falling interest rates and make some extra money. Take a look at how you can do that.
Investing all your money in a single asset class is like putting all your eggs in one basket. What happens if that one basket becomes shaky? The right idea is to diversify. When you invest in 2 different asset classes, like debt and equity, that tend to move in opposite directions, in different market conditions, the combination will have a stabilizing effect on your portfolio. When investing in a debt instrument, 3 things should be kept in mind: flexibility, capital protection, and taxation. While traditional investment options like fixed deposits and bonds protect your capital, they do not offer you flexibility. Debt mutual funds, on the other hand, have no lock-in and give better returns than a fixed deposit and are more tax efficient.
If you put your money in an FD, then the interest income is actually clubbed with your other income and it's taxed as per your income slab. But if you're a debt mutual fund investor, if you take an investment, if you put in an investment option with time horizon of more than a year, you can go in for a growth option and there you have the capital gains tax. So that is taxed at 10% without indexation or 20% with indexation.
The other big advantage that debt funds offer is the ability to profit from the interest rate cycle. Interest rates and bond prices are inversely related. Simply put, when interest rates begin to fall, the prices of previously issued bonds start increasing.
Actively managed debt mutual funds will basically earn from 2 sources. One is the accrual, the second one is capital gain. Typically, when the interest rates are falling down, which is the current scenario, a lot of actively managed funds, they raise the duration and they make capital gains out of it, which ultimately leads to a healthy return for the end investor. If you look at the last 1 month return for most of the actively managed bond funds, they're typically in the vicinity of 35 to 40% annualized returns. So I think in a falling interest rate scenario, the capacity of an actively managed fund to raise duration and capture the interest rate movement is far, far better than any other instrument, and hence a debt mutual fund will benefit the investors in a falling interest rate scenario.
So depending on your time horizon, you have the following debt mutual funds to choose from: the ultra short-term liquid funds, short-term funds, income funds, grid funds, and dynamic funds.
At this point of time, our opinion is that it's better to get into an actively managed dynamic bond fund, primarily because the rates have come off quite a bit and it's been a secular rally, to say so. So if you talk about, almost 40 days back, the 10-year GSET bond was roughly at around 8%, and now it's come off with the new 10-year benchmark being at 7-10 levels. So I think there's a considerable amount of rally which has already happened, and while the overall view remains that the interest rates will go down, but it will not be a one-sided rally and there will be intermittent volatility, I think a dynamic bond fund is an ideal fund to capture those kind of intermittent volatility and benefit the investor if the fund manager takes the right calls.
Falling interest rates can be an opportunity for you to get double benefits. The benefit of lower interest rates on your home loans, car loans, and other of good returns on your investment in a debt mutual fund.
We hope you got that down. Let me bring in Kumar now, the CEO of Value Research and our in-house mutual fund expert. We were just talking about how right now, if we want to put some money away in a fixed income investment, a dynamic bond fund would be best suited. Could you give us a list of dynamic bond funds that you would recommend?
Yeah, good dynamic bond fund. I would say that even income funds do qualify there because they also have the flexibility. Taking a broader selection of such flexible funds, I would say SBI Dynamic Bond Fund or ICICI Prudential Income Fund or Morgan Stanley Active Bond Fund. These could be reasonable choice.
Narendra, I'm giving you a list that you can use. It's on your screen right now. Write back to us if you have any questions about your debt investment. Let's move on now to our portfolio versus portfolio question. Loon has written in from Nagaland, Virendra. He tells us he's 35 years old and he has a 3-year-old son. He hopes to save for his own retirement and his child's education. He set himself a target of a little over 2 crore rupees over the next 10 to 15 years. He tells us he has a monthly income of 1 lakh rupees and he has a couple of insurance policies, 2 of which are term insurance, which seem to be providing him adequate insurance cover. He has not mentioned his health insurance, though, and that's something I'd like him to focus on as soon as possible. Apart from this, he invests 27,000 rupees a month in the list of funds that he has sent to us. He has the SBI Magnum Business, SBI Magnum Equity, Axis Equity, ICICI Prudential Balance, the Birla Sun Life India Generation Next Fund. He wants to know if his investments are on track. Will this group of funds take him to 2 crore rupees in 10 years, Virendra?
Yeah, very likely. But, I would still make 2 changes here. One is the role of a balanced fund here and the role of this Birla Sun Life Gen Next Fund. And he does not require a balanced fund because on one hand he has funds, a fairly aggressive fund like Magnum Emerging Business and Magnum Equity. And on other side, having a balanced fund does not serve a purpose. He should have an independent emergency fund which he can draw upon any time without any notice. Birla Sun Life Gen Next Fund, which its stated objective is to invest in companies which will benefit from the young population's Indian, young population, their consumption patterns. So it's a fairly loose definition, and sometimes it will do well. In recent times, it has done well. So as a low maintenance portfolio, long term portfolio, he can do without this fund as part of his portfolio.
All right, Virendra, if he removes the ICICI Prudential Balanced Fund and the Birla Sun Life Gen Next Fund, that will reduce his contribution by 5,000 rupees. What should he be doing with that extra 5,000 rupees? Is there a fund that you'd recommend he adds to this portfolio?
Yeah, I would suggest that he should consider 1 or 2 funds, and he should choose funds which are not overlapped with our, equity funds in our aggressive growth portfolio.
Loon, you seem to be on track. We just want you to do a couple of things. Start, of course, by creating an emergency fund, which is 3 months worth of your expenses in a bank account that you can access whenever you need it. Make sure you have health insurance for the entire family. And Virendra, they're asking you to make 2 changes in your portfolio, drop the balanced fund and the Gen Next fund, and replace it with 2 funds from our aggressive portfolio that's on your screen right now. Remember, you can write back to us if you need any more help. Virendra, we have a question now from one of our women investors. 55-year-old Poonam Jain has written. She writes in from Delhi. She tells us she's a homemaker. She has a couple of fixed deposits that have just matured, so she has a lump sum amount in her bank account. She'd like to invest it in an equity mutual fund. Now, she's not going to need this money in the near future. She has at least a 10-year horizon on it, but she'd like to be able to break it and withdraw partially whenever she needs it. So obviously, an equity mutual fund is something that would suit her, but which fund would you like her to invest in?
No, I would say that, somebody who has never invested in an equity fund before, and, there is a possibility that one might need the money, a part of it. One should not get started with an equity fund because somebody who has never invested before, one is faced with a 5-7% decline in a month's time, and your whole plan can get disrupted. So 2-3 things to do. One, choose a balanced fund. Then don't invest all this money, all your accumulation at one go. The possibility, of catching a market high in recent future, even if we face a decline of 10-15%, which could be quite a normal thing in case of equity fund. That will be, investing at one go lump sum can be hazardous. So spread your money at least over the next 6 to 12 months.
All right, Virendra, could you give her the name of a fund she can use for this purpose?
Yes, some good balanced fund, ICICI balanced fund, HDFC balanced, and UTI balanced.
All right, Poonam, the balanced funds that Virendra recommends you invest in are on your screen right now. You can write back to us if you have any more questions. Coming up after the break, Virendra is going to stay with us. We will talk about the L&T Equity Fund. We'll find out if its performance has slipped since that management change, and we'll find out if you should stay invested. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Kumar is with us as well in our Delhi studio. It's time for our product review of the week. This week we're looking at the L&T Equity Fund. Now remember, last year Fidelity sold its mutual fund business in India to L&T, and this fund was one of the funds that changed hands. Avana's going to give us an introduction of how the fund has performed in that last 1 year, and Virendra will tell us whether or not we should stay invested.
Thanks for that, Faye. Well, the name L&T Equity may not seem familiar to you. That's because the fund used to be called Fidelity Equity until March last year. Ever since the change, the fund, which used to be a top performer, has faced redemption pressures from various nervous investors. The fund, which used to be one of the biggest equity funds in our market, is now down to 2,300 crore rupees in assets under management. Let's take a look at its performance. In 2010, this fund ranked second out of 60 in its category, returning 26% in a year when the Sensex only gave 17%. In 2011, its rank dropped to 20 as it failed to beat the category average. And in 2012, the fund's rank crashed to 61 out of 70 as its performance slipped even further. But let's put some numbers together to give you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would now have 3,783 rupees today. So should you invest your money in this fund despite the change in the management? Our experts are here to take you through. With that, it's back to you, Faye.
All right, everyone, thank you for that information. Virendra, there was a lot of nervousness regarding the change of guard at this fund last year. A lot of investors wrote into us because they were worried about the performance. How would you rate the performance over the last year?
There is nothing outstanding, or there is nothing greatly disappointing about this change. Of course, this fund, in both the years has slipped on performance. At the same time, has not been able to beat its benchmark. That apart, this fund has faced massive redemptions because of the change. In 2012, the fund actually witnessed a gain of 25% on NAV. The fund returned 25%, and the assets actually went down by 40%. So that's quite disappointing.
Well, it is sitting at 61 in the ranks for 2012. For those of our investors who are still holding this fund, would you recommend giving up at this point, or is there hope for the future?
No, not at all. In fact, this remains a good fund, and I don't see anything greatly disappointing and greatly inspiring. I would say that there is a change of ownership. There has been a change of fund manager. It remains a very high quality portfolio. I don't find any questionable name in the portfolio. It has not slipped on the performance to settle at the bottom. So. And there have been times in the past, 2007 was the worst, was a very disappointing year for this fund once again. Last 2 years have been a little difficult, but I don't think it is time to quit.
All right, it's not time to quit yet. Virendra, would you give us a rating of the L&T Equity Fund? Where would you place it right now?
Based on, what I see in the portfolio and what I have seen in the consistency of performance over time, I would still give it a 4-star.
4 stars for the L&T Equity Fund. After that change of management, Virendra said it's been an average performer, but it's not time right now to give up on that fund if you have it in your portfolio. All right, it's time to move on to our hold or sell segment. Anandya Roy has written in from Kolkata on behalf of her mother, Nilima, who's 71 years old. Now, Virendra, she has fixed deposits that provide for her daily expenses through the interest that they generate. Her aim with these funds is to generate a tax-free additional income and to guard her capital from inflation so she can pass it on to her successors over the long term. She has about 13 lakh rupees invested in these funds. She wants us to go through the list and make sure that her funds are on track. Now, first on her list, she has 2 HDFC long-term MIPs, Virendra. given what she wants to do with this portfolio, would you recommend she continue these investments?
No, these are undesirable investments because, what is clearly being spelled out is no dependence on these investments for day-to-day consumption requirement or income need. So, this will not serve the purpose of, tax-sheltered accumulation, which will be able to beat inflation, or, reasonable growth in a tax-efficient manner. This is not the vehicle.
So the next two funds on her list are HDFC Top 200 and HDFC Tax Saver. Now the Tax Saver lock-in won't expire till December this year, and HDFC Top 200 seems like the kind of conservative fund she should have in her portfolio. Should she continue both these investments?
Yes, absolutely. These two funds, they are worth holding on, and they will very well serve the purpose, and they will match with the goals she has set for herself, which is growing this money efficiently and well.
Alright, so those two funds are approved. Dhirendra, I want to take the next three together, and the number of funds in her portfolio are causing me concern because it obviously means more time spent in maintaining this portfolio. She has Reliance Growth, Reliance Vision, and Reliance Regular Savings Equity. Does she need all three?
No, she can do without the first two, and that should be enough. Ideally, for a portfolio for her should be still little conservative, even when built with entirely an all equity portfolio. So from that standpoint, Reliance Regular Savings Equity might be the best of the best choice of the three funds she has.
All right. So far we have Reliance Regular Savings Equity and the HDFC Tax Saver in your portfolio, along with HDFC Top 200. Also on her list is the SBI Contra Fund. Dhirendra, continue that investment?
Yes, this fund actually was extremely disappointing a few years back, and now it has made a modest comeback. Yes, worth holding now.
Last two funds on the list, UTI Master Share and UTI Dividend Yield. Again, does she need both of these funds? UTI Dividend Yield is the kind of fund you were talking about in terms of a conservative equity fund. Should she consolidate that money?
Yes, of course. I like Master Share more for other reason that, a Master Share has to pay the annual dividend, and for that it is very conservatively run. The profile of Master Share is little different from the underlying looks alike, like the dividend yield portfolio managed by the same fund manager. And this annual commitment to pay dividend, that drives this fund to configure its portfolio differently. So I would say choosing one of the two funds, I would say go for Master Share now.
All right, choose the Master Share fund. Dhirendra, also, like you said, she's picked the dividend option on all of her funds, and given the fact that she actually just wants to beat inflation with this portfolio, would you rather have her switch to the growth option instead?
I would say that, it's, yes, that will be a desirable thing given the goal that you want to accumulate efficiently and well, if that is the plain goal, if that's the only objective. But if periodic dividend from these funds help you, these are needed support and they're helpful, then maybe, continue with your dividend plans. But if they are just surplus landing into your bank account and which you have to consume or subsequently invest, then that recycling of the money, getting it back and investing again doesn't make sense. Move your money to the growth plan.
All right, so there you have it. That's your final list on your screen right now. And Dhirendra saying only if you really need that monthly income, then opt for the dividend option. Otherwise, it's more tax efficient to use the growth option. Dhirendra, we have one last question that's come in from Raghavendra Gupta, who says he's 36 years old. Now, he tells us he had been investing into the equity market directly through stocks based on tips from his broker, and he's lost a lot of money. He wants to now begin investing for his 5-year-old son and plan for his own retirement. He can save about 15,000 rupees every month, and he wants to know where he should begin investing. So we talked to first-time investor. So this is a second-time investor who's burnt his hands on equity once before. What would you like him to do?
No, I would actually, like to provoke him that he was not an investor. He was a speculator, and now he has learned his lesson and now getting back to investing. Getting started now, after having learned his lesson, get started with our maybe the growth portfolio or the aggressive growth portfolio, given your time frame. And aggressive growth portfolio might be a superior, temperamentally you will be much more suited to it. And regular investing, you will find the difference, the way you accumulate. And I would urge that going by your experience in the past, you will be tempted to look at the values every other day resist that temptation.
Virendra, thank you so much for spending time with us on Investor's Guide this week. If you have questions for Virendra, write to us. Email ID is at the bottom of your screen. Coming up after the break, we'll find out how you can invest a lump sum of money and get a regular income. Don't go anywhere. You're watching Investor's Guide in ET Now. Thank you for staying with us. Let me bring in Gaurav Mashruwala, who will answer some of the questions you sent in during the week. Gaurav, thank you for joining us on Investor's Guide. Our first question is from a woman investor. Well, Shramona Ray has written in. She's a BTech student. She tells us her father recently passed away and her family received 20 lakh rupees from his Provident Fund account. Well, Shramona, we're terribly sorry to hear about your loss and we'd be glad to help you in any way. Feel free to write to us. She wants to know, Gaurav, where she can invest that money to generate a monthly income, because currently there is no earning member in her family. Her mother is a housewife and her younger sister is only 8 years old. She wants to know how she should invest this money because it does seem like a lot of money for her. Gaurav, how would you like her to invest the money so she can generate an income and also protect it from inflation in the long term?
Shramona, what you need to do is look at a couple of things. One is you are a student, you have a younger sister who is also a student and a housewife mother. So what you need to, one thing you need to do is you need to have certain amount of contingency fund. So whatever is your monthly mandatory expense of the family, keep aside that money for contingency. Give about 10 to 15 days reserve in form of cash at home, so in case there is illness and hospitalization, etc. Rest money can be kept in a savings account which is linked to fixed deposit. So first, from the 20 lakh, create contingency fund. Second thing that you will do is purchase health insurance for your sister, for yourself and for your mother. If your mother is a senior citizen, then there could be little difficulty, but there are policies available for senior citizens as well. Then we come to your important question as to the residual amount, which would be somewhere in the region of 19-20 lakhs, 19.5 lakhs after you spent on contingency and health insurance. Where should you be deploying? Since family requires regular income till the time you complete your education and you start earning, I would encourage you all to put in two things. One is post office monthly income scheme and bank fixed deposit. Now there are various banks who would give you interest quarterly. In fact, almost all banks will give you a quarterly payout option. What you want to do is you want to go to a bank which is nearer to your house and where you have ease of operation, where you have other banking relationships. So don't jump for a bank which gives you highest interest, because the difference between the two may not be higher, but you would rather establish a relationship with an existing bank. Ensure that the deposit is in joint name with your mother and yourself. So in case any one of you all need to do any kind of transaction with that, that's possible. So to begin with, bank fixed deposit and post office monthly income scheme. Over a period of time, start looking at also investing in equity-based mutual fund, because the corpus will have to grow at a rate higher than inflation. But that could happen in a second stage. But till such time, contingency fund, health insurance and bank deposits.
Our next question comes in from Mahendra Sharma, who can save about 10,000 rupees a month. He tells us his daughter is 1.5 years old and he wants to know where he can invest to protect her future. Gaurav.
Mahendraji, three important things. First is, instead of straight away looking at portfolio, since you also asked for information on health and general insurance, some health and life insurance, that's the area that you should start with. So first look at health insurance for yourself, for your spouse, as well as for your daughter. Normally, once a child is 91 days old, insurance companies will be willing to give cover. So ensure there is sufficient cover for yourself. Depending on the city that you live in, you would require a cover anywhere between 1.5 lakhs to about 3 lakhs. And if you're sitting in bigger cities like Delhi, Bombay, Bangalore, then maybe even you want 5 lakhs for yourself and 3 lakhs per child. Life cover, I really don't have any idea as to what all other responsibilities you have. So based on what are the responsibilities, do you own a house, do you have a loan, you need to look into that. Now coming to your question on generating 15 to 20% return, well, it's difficult to guarantee those kind of returns, but usually equity as an asset class has over a longer period of time generated those kind of returns. Since you are looking at investing 10,000, I would encourage you to start an SIP into an equity mutual fund on a monthly basis. If you are familiar with mutual funds, then you can start with actively managed funds. If you are not, then you look at an index fund, either a Sensex fund or a Nifty fund. and keep increasing this amount by 10 to 15% every year. In all likelihood, by the time your daughter is old enough to go to school or go for higher education, you would have the desired corpus.
We have one last question. Sunny earns 40,000 rupees a month and he wants to pick a tax-saving mutual fund so he can save on tax. Gaurav, can you give him a tax-saving fund that he can use?
Sunny, since you're looking at tax benefit and that specific query that you have, then the only option that you have is equity-linked savings. Usually I encourage people to look at their financial goals first and then link investment to their financial goals in a way that there are instruments which gives tax benefit. Now, you have not mentioned your financial goals and you have also not given other details about your tax savings. So, if tax saving is the only aim and if mutual fund is the only vehicle that you are choosing from, then equity-linked savings scheme is the only option you have. There is one more option which is pension plan. There are two mutual fund companies which offer that, UTI offers and Templeton offers. So that's another option which are pension plans. So otherwise, equity-linked savings scheme is the scheme which will give you benefit under Section 80C.
That brings us to the end of Investors Guide this week. Gaurav, thank you so much for joining us on the show. Now, if you have questions about anything to do with your money, feel free to write to us. Email ID is at the bottom of your screen. We'll be glad to help you with anything you might need. Also, you can catch this show on our Facebook page as well. Join in on our Facebook page to get updates on the show and about all the specials that we do. Tune in next week to catch Investors Guide. Thanks for watching.